Welcome, everyone, to Ancient Roman Trading Secrets with General Romulus. That's me, Romulus. This show is brought to you by Backpack Trader. Our goal is to help you become the best version of the backpack trader you can possibly become. And before we get into the goodie bag of trading today, I want you to take a second, step back, pause, breathe, relax, and think about what it means to be a backpack trader. In control, in command, is that you? Are you running your own show? Are you making all the choices? Are you calling all the shots? If not, you need to become a backpack trader. That's what we do around here. Well, markets are reacting to temporary oversold conditions. See, the S&P falls 3 days in a row, then a little bit of a bounce. Dow actually was down this morning. Earlier, that was 4 days in a row down there. That's not the issue. The big deal this coming week really is about Jerome Powell, Federal Reserve, Jackson Hole, speeches, interest rate environment. So that's what we want to focus in on here. You see, this is the 2-year. This is the amount of interest, 3.36%, that the U.S. federal government will pay to borrow your money for a total of 2 years, 3.36%. Now, these purple lines, these famous purple lines, and by the way, it's General Romulus. Romulus is the founder of the city of Rome. He was actually the first king of Rome. Of course, he led the military as well, which is what I prefer to go by. But purple bordered togas. Purple bordered togas was a big part of the ancient Roman culture, and it was a signifying distinction of royalty. On our charts, it's a signifying distinction of, hey, check this out. So the 2-year breaking out, this is called a ascending. Let's get it correct, everybody. That's called an ascending triangle going up. Why? Because the points here, the lows, are increasing, and the high is kind of stuck right there. You see that right there? Kind of stuck. But a little bit further push, and it would be trading at about a decade and a half high. The 10-year, also the amount of money that the federal government will pay to borrow money for 10 years, which is about 3.1%, almost, give or take, just shy of that. That is rebounding, although not in as strong of a position as the 2-year. That's what I love about charts. We just look at them. Once you get used to them, move along, get comfortable, you can start getting that into that zone and quick reads, all with your eyes. Pretty great stuff. Okay, another piece of news this coming week, Tesla, that stock rebounding with the market, not unusual. Splits tomorrow, 3 for 1. Here's the thing, though. 6 months, a year, 2 years, 3 years, 4 years ago, Tesla announced a stock split, and the stock would have been flying, raging, and just going nuts. The fact that it's only up mere pennies, that's starting to tell you something about the overall sentiment involved in the Tesla situation. Much, much different than it was. Much different. Bloom is far off that rose right there. Speaking of blooms and roses, anybody else see this here? AMC, the second most popular meme stock after GameStop, if I can get that right. New 52-week low yesterday, new 52-week low today. Yeah, you guys should have been watching the Romulus videos about 2 weeks ago when the Bed Bath & Beyond thing was taken off. We warned you. So hopefully you have not taken a bath too much in those situations. And even though a little bit of a rebound today in the markets, not enough in the more speculative areas to fire those things back up again. And I'd give it a couple of months. If indeed there is another firing to come, but wouldn't be expected for a couple of months at the earliest. Here's a stock that you've heard me mention quite a bit. I own this one, so that's my disclosure in there. Bought it back in early June, and every week or two I sell off covered calls. Got a lot of money for the calls when the stock popped over here after the earnings. That makes sense. Stock was up almost 30% that day. Nowadays, I get 3 cents or so for each call I sell. Again, I'm getting ones that are expiring just a few days away, so I don't expect a big premium on those. Anyway, regardless, the stock is one of the bigger performers on the markets around the country today, and no news related to it. Although one of my centurions sent me a note and said possibly the student loan situation could be a beneficiary for the company. But that kind of confuses me a little bit because that would take some of their loans away. that would diminish their loan count, their loan volume. And aren't banks in the business of making loans? Anyway, but it could be maybe because their customer base would be in a little bit of a stronger financial position because of that. Regardless, it's one of the bigger winners today. And hey, we're taking that, no problem. All right, diminishing volume continues to plague the markets, although now it's definitely a summertime issue. But you can see, though, when the rally started on June 16th, 17th, the volume has been steadily declining. Even this was long before summer really kicked off, at least summer vacations and lower volume. And that's not normal. If this is indeed the birth of a new bull market, this would probably be the first one in U.S. history that started like this, on this extremely low volume and other divergences and other indicative possibilities that demonstrate a growing possibility that this was not the birth of a new bull market. But until some of these, the 21-day moving average was certainly taken out here, and it continues to trade below that. But until the 50-day gets taken out, that trend line, some other issues over here like these lows and these lows, then it's just simply an ongoing uptrend until otherwise. And kind of working on a theory in here that's going to take a bit to flesh out and put a little more meat on this bone. But it's possible also that we're in something like the 1970s. If you go look back, historians look back, the Dow Jones crossed the 1,000 marker for the first time in February of 1966 and didn't get across it again permanently until August and September of 1982. Over 16 years. It was just stuck. So it was trading in this massive range. It would hit 1,000, give or take, and then pull back. Sometimes it was a nasty bear market like in 73, 74, which was totaled about half a loss on the entire broad market. Sometimes it was 20, 25% pullbacks. We could be looking at a situation like that. I mean, the inflation higher than it's ever been since 1980, 81, although cooling off a bit, but still running high. And with all the global disruptions going on, not just the war in Ukraine, but also climate problems and other situations, perhaps we're in a situation where, because markets were so priced to perfection by the end of last year, that there's only one way to go, and that's sideways for a long, long time to work all that out and work it off. So just keep that in mind as a possibility. How to thrive and succeed in environments like that: more trading, a little more movement, and don't get stuck. A lot of people out there are still beholden to the modern portfolio theory, 60-40 type of investing. This is for the retirement account status that has worked very successfully from 1982 until a few months ago. But if my theory is right, and this thing does hold water, that way of doing business, that method of managing bigger money, of running retirement accounts, pension plans, 401ks, is not going to work. But there's there's two generations now that are so baked into that cake, they don't know how to act or think any other way. Dangerous, very dangerous stuff. Okay, great. Well, this has been who? You guessed it, General Romulus. And I am ready to go back to ancient Rome to finish up the campaign season. We're still up in northern France fighting Gauls and barbarians by the thousands. But hey, that's what we do. We're Romans after all. I'll see you guys tomorrow. Have a great day. That is all for now.